How to start investing in 2026. A complete beginner's guide. Investing has a reputation for being complicated something for people with finance degrees, or a lot of spare cash, or both. It's neither. By the end of this video, you'll know exactly what account to open, what to actually put your money in, and in what order to do it. No jargon, no guessing, just a clear starting point. Here's the simplest case for investing. Cash sitting still loses value every year to inflation. We covered that in our Money Traps video. Investing is the only realistic way most people turn today's dollars into meaningfully more dollars later, because your money is out there working, compounding, instead of quietly shrinking in a drawer. Before a single dollar goes into an investment, two things should be roughly in place: some cushion of savings for emergencies, and no high-interest debt sitting on a credit card. We go deep on both of those in other videos. You don't need either one perfect just started before investing becomes worth doing. If your job offers a 401k with a match, that's step one, full stop. A match means your employer adds money to your account simply because you contributed often 50 cents or $1 for every dollar you put in, up to a limit. Skipping that is turning down free money before you've even started. The 401k itself is just a tax-advantaged account offered through work. Money comes out of your paycheck before you see it, which makes it easy to stay consistent. And it grows tax-deferred until retirement. You pick investments from a short list your employer provides. We'll cover exactly what to look for shortly. Next is the IRA, an account you open yourself, outside of work. There are two flavors. Traditional lowers your taxes now, and you pay tax later, when you withdraw. Roth is the reverse: you pay tax now, and it grows completely tax-free after that. As a rough rule, if you expect to earn more later in your career, Roth is often the more favorable pick, but this depends on your specific situation. The third option is a plain taxable brokerage account. No special tax treatment, no contribution limit, and no restrictions on when you touch the money. It's what you use once you've filled your tax-advantaged space, or for a goal that isn't retirement, a house, for example. So, here's the order most people follow. Get the full employer match first, since it's an instant return nothing else can match. Then tackle any high-interest debt. Then fill a Roth or traditional IRA. Then go back and max out the 401k if you can. Then the brokerage account after that. We map this out in full detail in our financial order of operations video. Now, the part that intimidates people most: what do you actually put your money into? You are not required to pick individual companies. For most beginners, a small number of broad, diversified funds does the job better than trying to guess which stock wins. We break this comparison down fully in the next video. Diversification just means owning a little of many things instead of a lot of one thing, so no single company's bad year can sink your entire plan. A broad fund can hold pieces of hundreds or thousands of companies at once, which spreads that risk automatically. Set up automatic contributions on a schedule every paycheck or every month, and then largely leave it alone. This is called dollar cost averaging. You buy at whatever the price happens to be each time, high or low, which removes the impossible task of trying to time the market. Investments go up and down, sometimes sharply, in the short term. That's normal, not a sign something's wrong. The longer your money stays invested, the more that short-term noise tends to smooth out. Panic selling during a dip is one of the most common ways people turn a temporary drop into a permanent loss. Pay attention to the expense ratio, a small percentage taken from your balance every year to manage a fund. It sounds tiny, but over decades, even a difference of 1% can cost you a meaningful chunk of your total balance, because you're losing not just the fee, but everything that fee would have compounded into. A common myth is that investing requires thousands of dollars up front. Many platforms today allow you to start with a small amount and even buy fractional shares, a partial slice of a fund, instead of a whole share. The amount you start with matters far less then starting consistently and letting time do the rest. Let's recap. Get any employer match first. Handle high-interest debt. Open a Roth or traditional IRA. Keep it simple with broad, diversified funds instead of picking individual stocks. Automate your contributions and give it time. And watch the fees, they matter more than they look. If this helped, follow Liberty Wealth Insights for more financial education. Made simple, in plain English, no jargon. We'll see you in the next one.